Hello, and welcome to myfinancesteacher.org. Let's have a look at gold in this video, and this time we're going to start with the US dollar. Before we continue, let me remind you guys to subscribe to the channel if you haven't, and click that bell notification. Thanks a lot. Sometimes there is a negative correlation between the US dollar, in this case the DXY index, and gold, and sometimes that negative correlation disappears. Looking at this period from September to December last year, when the intermediate cycle in the US dollar was in its declining phase, clearly the DXY index was gradually declining, and what happened to gold at the same time is it also declined as gold was in its declining phase as well within the half-a-year cycles. What happened in the first couple of months of 2020 is again some positive correlation. So again, the usual negative correlation disappeared. In the first couple of months of this year, US dollar was gradually going up. And what happened to gold is it was also moving upwards within the first couple of months of this year. However, it looks like over the last month or so, there is again some negative correlation between the strength of US dollar and the price of gold measured in US dollars. Such as here, for example, starting from late February into early March, we see a significant drop in US dollar. And during the same period, gold price moved by nearly $140 upwards. After that, with the major hit on the general stock markets, we see an explosion in the US dollar upwards. And again, during this same period, gold actually declined significantly, showing that US dollar and gold continued to have a negative correlation in that period. And more recently, since around 20th of March, US dollar declined significantly, and during that same period we see a significant increase in the price of gold. So at least over the last month, there is a negative correlation between the price of gold and the strength of the US dollar versus other currencies. So let's have a quick look at the US dollar. The medium-term cycles in US dollar generally last for about half a year, but one way of looking at the previous intermediate cycle is having the cycle continue between late June last year into the end of December, early January. That would give us a regular half-a-year cycle. For now, I think this is the way I'm going to keep the count for intermediate cycles in the US dollar. Although there is an alternative way to look at this cycle, saying that the cycle actually continued between late June 2019 and early March 2020. That would give us 8 months instead of the usual 6 within this intermediate cycle in US dollar, which is quite likely. There is a large variation in the intermediate cycles in dollar. In either case, we are now in a new intermediate cycle, which so far seems to have started at the beginning of 2020, although there is a possibility we've started this new cycle in early March. In either case, volatility in US dollar is extremely high over the last couple of months, of course, clearly due to the high volatility in all the markets, the general stock market, crude oil, gold price, and dollar as well. But whether the intermediate cycle started 3 months ago or 3 weeks ago, zooming into the daily cycle in US dollar, it's only been going on for 3 weeks. Generally, these cycles last for 1.5 to 2 months. About a week ago, the US dollar has already poked through the Bollinger Bands, and we're now in the middle of the Bollinger Bands. So clearly, the US dollar has started the move down within the ongoing daily cycle, short-term cycle. So over the next couple of weeks, I expect some weakness in dollar in general. However, in the shorter term, we might see a bounce from several moving averages all coming up at about 98 on the dollar index. As we see, the red line here is the 20-day moving average. We also see the 50-day and 200-day moving average all located close to each other, and actually 100-day moving average is in the same area as well. Looking at Fibonacci retracement, the 200-day moving average is very close to 62% retracement. As we mentioned many times, 38, 50 or 62% retracement are the most common ones. So that 62% retracement, together with several of the moving averages, might provide some support zone for dollar in the short term. So there could be a bounce for, say, a week or so, possibly followed by a further decline in the US dollar. However, if the stock market for some reason crashes again, that will likely lead to another run into the US dollars. So let's have a quick look at the futures for S&P 500. Today so far is a green day. The futures at the moment are just a little bit below the price they closed at on Friday. So there is not much volatility in the moment in the general stock market, which means we're unlikely to see huge amounts of volatility in the dollar as well. So my outlook so far, short-term strength in the US dollar for over the next several days, continued by a gradual decline, somewhere into the middle or second half of April possibly. So with that in mind, let's have a look at gold. As I mentioned in my previous video, somewhere in the middle of March I was expecting a short-term bounce in gold price followed by a lower low. However, it looks like the bounce here in the second half of March has been quite strong. I didn't expect so much of a bounce. That's why I mentioned in my previous video that there is a chance that we have seen a shorter than usual intermediate cycle in gold lasting for only 4 months rather than 6 months. That is also not extraordinarily unusual. I'd say it's just somewhat unusual. But with so much volatility in all the markets right now, it's hard to say whether we will stay within the ongoing intermediate cycle and finally will make a lower low somewhere into April. In either case, for now I am betting on stronger gold price with my 80% allocation mostly into gold itself rather than the miners in my gold related part of the portfolio. Now zooming into the ongoing daily cycle in gold, whether it's part of a new intermediate cycle or whether we are still within the intermediate cycle that has been going on since December last year, the ongoing daily cycle has only been going on for a couple of weeks. As these usually last for a couple of months, the daily cycle is young enough for us to see a higher high over the next short term. And with a couple of weeks duration already, it's also possible that we are going to decline for the rest of the short-term daily cycle. I know so far basically this says we might either see higher high or go down, but there is some interesting information I want to convey. Look, if we zoom in looking at 4-hour chart, it looks to me that we see a bull flag so far forming on gold price. And as long as we stay within this bull flag, as long as gold doesn't break below somewhere between 1600 and 1610, I still have enough conviction to stay with my 80% allocation in gold-related assets. If we break above the upper range of this flag pattern, meaning that if we break above somewhere around 1660, we can easily retest the recent highs at 1700 and possibly even go higher to that target of 1725 that I mentioned in one of my earlier videos. That of course would mean that we are in a new intermediate cycle and the previous one lasted for only 4 months. Alternatively, if we break below that area between 1600 and 1610, I would probably have to sell my position with a tiny profits. In that case, we'll have to wait and see whether gold will actually create a lower low, completing the intermediate cycle within the normal duration of about half a year starting in December last year. Given our expectations on the US dollar with a short-term bounce over the next few days before going down into the short-term daily cycle low sometime into second half of April, I think there is a good chance gold declines down to that 1600 before shooting up towards the 1700 level. So the scenario with generally stronger gold price over the next few weeks is now slightly more likely than a significant drop in gold price, but the difference in likelihood among these two scenarios is not that great. There's probably a 60% chance that we're going to see stronger gold over the next few weeks, but there is also a pretty high likelihood, I would say maybe a 40% chance, that gold breaks down to retest the recent lows at about 1450. And next, let's have a look at GDX. GDX is another market with very high volatility. As gold is likely to retest 1600 over the next few days, GDX is likely to close this recent gap, and the gap is between 2330 and 2380. But just like with gold itself, if we go much deeper than 2330, GDX is likely to retest the recent lows at 19 or even at 17. So I want to keep my stop losses tight below that gap for GDX itself. Although at the moment I have mostly gold rather than gold miners in my portfolio, as some of the mines are shut down at the moment due to the health concern issues. That reduces the supply of gold, so the stock prices of the miners themselves might do poorly while gold price might actually do well in this environment. And whichever scenario takes place, the most important thing is to stay healthy. So be careful out there and good luck in your trades.